What you might learn about if you study statistics/finance, you'll hear about the normal distribution, that bell curve, okay, the normal distribution. Widely used, widely known, nice and easy to work with, but beware when you make assumptions. If you are, depending on your level of study, looking at financial models which assume normal distributions for returns. These are histograms. That's the FTSE 100. That's the S&P 500. This is the Dow Jones. They look very similar in shape. Do they look close to a normal distribution? I would say yes, but critically, one major difference. What we talk about the so-called fat tails. Not an elegant phrase, but quite a widely used phrase. To look at the extremes. Extreme things. They are rare. That's why they're called extreme. However, rare events occur in practice a little bit more often than a typical normal distribution would predict. Some of you may hear about these sort of 3, 4, 5 sigma events. A sigma being a standard deviation, and for a normal distribution to be more than, let's say, 2 standard deviations below the mean, or more than 2 standard deviations above the mean, would be very rare indeed. Yet in just 3 or 4 months, we were seeing swings of up to 10 standard deviations up and below. And it's those tail events, that's where your opportunities lie. Of course, risks, you call it wrong, you lose a lot, but potential for huge gains. So returns are typically not normally distributed. Those tail events, they're the ones that get you, they're the interesting ones. The VIX, this is Wall Street's fear gauge. It is a measure, I'm not saying a perfect measure, but, or if you like, an indicator about how scared the world via financial markets is. This is, again, the early stages of the pandemic. In a normal period when the world is okay, the VIX below 20 is about usual. Anything below 20, don't panic. Anything above 20, panic. February, COVID's in the news, but we're just a few weeks away from the first lockdowns in major industrial countries, an unheard of, unprecedented event. This shot up to what, 65, whatever, there in the early days. But then the financial markets, they receded. It was still high, but it had dropped significantly. I think this is humanity being over-optimistic. People don't like to think about bad events. They don't want to think about death, disease, etc. And I think there's a bias in individuals which potentially you could exploit, that people tend to overestimate the probabilities of good things and underestimate the probabilities of bad things. I would say humans are somewhat irrational. This is the full history of the VIX index. Again, an indicator of how scared financial markets are, going back to its origins of early 2000s. Now, again, for the VIPs in the front row, we remember the global financial crisis well. Whether those are happy or sad memories, who knows, but we were around then. And the VIX, it was reaching an all-time high. Curiously, the pandemic, which I think on any metric was multiple times worse than the global financial crisis. For global financial crisis, some Americans lost their homes, those in the UK and other parts of the world too. Unemployment shot up. But this was nothing compared to COVID. People's lives on the line. The economic costs of COVID vastly dwarfed those of the global financial crisis. Yet, the VIX index, at its peak, was still below the global financial crisis. This is, to me, is completely irrational. If GFC, global financial crisis, was there, the COVID impact in the early days should have been sort of wet off the scale, almost. So again, was this maybe over-optimism of the financial markets? Again, easy with the benefit of hindsight. If you're thinking about it ahead of time, maybe you think things will be worse than the markets think, then you may benefit from it. Which would you choose? Imagine. Appreciate returns are not normally distributed. We've got these fat tails. But you pick any stock you like, which we'll hear about this in our next little presentation. Pick any stock you like. Look at the historic returns, maybe on a daily basis. Sometimes it will go up a bit, sometimes down a bit. And let's say you're just plotting a simple histogram of returns of any asset of interest to you. So let's just call these, for reference, the black and the red. These have been defined such that on average, they are on 0. two distributions the same mean. So if you've ever taken any basic stats course, two things you learn about are mean and standard deviation. I've been discussing expectations, which means a mean. But clearly, we do care about risk as well. We care about deviations from the mean. So while you will indeed hopefully look at expectations, it's arguably perhaps oversimplifying. You do want a sense about the deviations from the mean, for which the standard deviation, a statistical measure, but a great way of capturing the risk of an asset. Now, which would you choose? So let's say these are the historic returns of two company shares. It's called the black one and the red one. Okay? So we're looking at here, a big return plus 7.5%, low return loss minus 7.5%. So I'm just curious, for yourselves, if this was your own money, hands up if you would invest in the black stock. Great. Hands up if you would invest in the red stock. Great. So we got a difference of opinion in the room. And clearly there's no right or wrong answer. It's about your attitude to risk. Some of you will be risk lovers. Some of you will be somewhat risk neutral. Some will be very risk averse. It's fine to be any one, but that's down to you. I don't care what your risk appetite is, but you should. And depending what your risk appetite is, then I would suggest that should have some bearing in which kinds of assets you want to invest in versus ones you wish to avoid. The trend is your friend until it ends. Just a word about data. If you look at it, all data is from the past up to the present. The past is never a perfect predictor of the future. History often repeats itself, not perfectly, but sometimes it at least rhymes. So indeed, look for trends. Maybe you have a trend following investment strategy. But beware, trends can indeed, they will not go on indefinitely. They sometimes end.